How's everybody doing? My name is Bob Iaccino. See, there's a lot of people here, but I think there's a lot more registered. So I'm just going to wait a few minutes and then I'm going to go ahead and get started on this presentation, Mastering Trailing Stops. Trailing stops is a critical thing, especially in the early development of traders. So I'm going to go into this in sort of an educational detail, and then we'll talk about some of the benefits and some of the failings of them from the perspective of the trader. So let's just wait a few minutes and try and let a couple more people in, and then I'll go ahead and get started. Not going to wait very long, though. I mean, we're going to get started on this. This, again, is a very, very critical subject. And while we're waiting, I want to point you guys to the disclaimer at the bottom of the screen. Trading in futures and options carries substantial risk of loss and is not suitable for every investor. That is not to be taken lightly. And that's part of what trailing stops are about, is sort of understanding and controlling that risk as you learn and as you progress. Now, I've been doing this for 31 years. I still use trailing stops. They're actually an embedded part of my own process, but that doesn't mean it's going to become an embedded part of your process. So let's get into this in about 2 more minutes. I'll just get started. We're going to talk about mastering trailing stops. This is a webinar brought to you from Plus500, the only platform built for traders by traders. This is built for the retail trader, and the trailing stop part of this platform is one of my favorite things. So in this particular presentation, we're going to talk about the importance of risk management in trading. We're going to talk about what trailing stops are and how they work. We're going to talk about how to set up and use trailing stops on the Plus500 app, best practices and common mistakes to avoid. And then there will be a Q&A in this particular presentation. I don't want you guys to not ask questions. If you have a question, ask it, I should say. If I don't see anything listed in here, I won't keep you much longer than the scheduled time. But if you have questions, ask them. I think it's pretty important to get your questions answered. So why do most traders lose, and what's one of the ways that you can avoid those losses? Well, a mistake that many traders make is they exit trades too early, and sort of the opposite side of that, the other side of the coin for that mistake, is they hold positions too long. Both of those two mistakes, really built into one, reduces long-term profits, because while you're holding losses at a predetermined level, you may even be increasing losses. One of the big mistakes that a lot of people make is they move a stop loss further and further away as a particular trade goes in the wrong direction. The second part of it is it leads to emotional decision making. If you don't have a process in place, then you're not really doing things in a sort of measured way. You're doing things emotionally. One of the parts of that is taking profits too early. And this is one of the things that trailing stops tries to guard against, okay? It tries to get you away from taking profits too early by maybe taking small profits, or at least assuring your psychology that whatever loss you had planned is being reduced along the way by the moving stop. So what is a trailing stop? A trailing stop is a dynamic stop loss that adjusts as the price moves in your favor. It locks in gains while keeping you in a favorable trend. If price reverses by a set amount, the trade automatically closes, and it may secure profits but cut the trade before maximizing gains. That's sort of the negative side of it. But this is especially useful for newer traders, because what often happens is you get this emotional fear response, and you're in a trade, it starts going your way, and all you can think about is, I've got money right now, and if it turns against me, I could lose that money, plus I could even go negative or back to where my original stop was. A trailing stop allows you to guard against that emotional action while still watching the entire trade playing out. It also allows these sort of fluctuations, again, knowing from your psychological standpoint that you have a stop in place that's been tightening up the whole way, that you're not going to turn this particular trade that's gone your way from a winner into a loser. It may turn from a winner into a smaller winner, but it's not likely to turn a winner into a loser. So it's a dynamic stop that follows your trade in the correct direction, in the direction that your profits are going. So that's what a trailing stop is. It's very, very important in reducing risk, okay? You stay in profitable trades longer with the reduction in risk that comes with a trailing stop. One of the problems traders have is they're in a trade. Let's say they got into a trade and they said, I'm only going to risk $100 on this. And now the trade is up 50, then it's up 100, then it's up 150. They decide, I'm going to cut it, because the worst thing that can happen to me or you psychologically is that paper gain of $150 turns back lower and turns into a loss of $50, because in a trader's mind, you've now lost 200, when in reality, factually, you've only lost the original 50. If you have a trailing stop with that same sort of example, up 50, up 75, up 100, up 150, now it turns, you've got a trailing stop. It goes from being up 150 to a closed position that banks you $100 in this fictional example. So that's what a trailing stop is. It's a stop that dynamically moves in your favor as a trade goes in your favor, and it protects you from a big gain becoming a normal size loss. So how do trailing stops work? This is a slide describing the mechanics of a trailing stop. So on the Plus500 app, when you're entering a trade, there's actually a button, and you can see it here, okay? It says trailing stop. I don't know if you guys can see my mouse, but it's in the left-hand side of this image on the slide. You can see very clearly that you've got an order up here on your Plus500 app, and about midway, a little bit lower than midway down through that particular image, you'll see trailing stop. Well, you can highlight that trailing stop button, and then you can either do it from a dollar amount or a percentage basis. And again, the trailing stop will follow your trade in the correct direction. So when you initiate a trade, you trigger the trailing stop on the app, and then you decide how far it's going to be, okay? Nadia is asking me to show the button on the screen. I can show you when we're done with this. I can open the Plus500 web app and show it to you on there, okay? But it's on the screen right now. Let's see if I can highlight it for you with a pen here, right here. Annotate. It's basically right here, okay? Can you see that? Trailing stop, and the button is right there. So this is a normal order ticket, okay? It's a normal order ticket. Now I got to figure out how to erase this because I don't remember how to do that. Let's see if I go to the next screen where it is. So that's the trailing stop button. Nadia, were you able to see that? I'm hoping you were able to see that. I can annotate it again for you. Right there. See it? It's circled right now. That's where the button is. And you can see that anytime you place an order, okay? You'll see that button right there. It's either in blue, which means it's in effect, and you could choose where your trailing stop is, or it's in gray, in which case you're either going to add a manual stop or you're going to just skip a stop entirely and put it in later, which I don't recommend doing. If the price reverses by a predefined distance, the stop triggers and closes your position. Now, you can do this as a limit order or as a market order. I recommend on trailing stops specifically, you use it as a market order. That's my recommendation, not Plus500's, but you can do it based on your own particular process. If you click that trailing stop button, I'll annotate this again. You can use the plus or minus, or you can type it in. Right here is the plus or minus. You see that? Or you can put the price of the trailing stop higher or lower, okay? And then it will automatically adjust as the trade goes in your direction, okay? So once it does that, you can see below there that there will be a percentage listed as well, okay? And that percentage will tell you where the percentage is versus the price that you've put up there, okay? Now I'm struggling to get rid of this again. All right, so you'll see in the gray, it'll give you a percentage of what your gain is, or how far away that trailing stop is, I should say, from the actual price that you've entered the long or short in. All right, so that's how that's used. There are types of trailing stops. Okay, the percentage-based type of trailing stops is what I use personally. Okay, I use 12.5% increments. That's a whole nother webinar. But that's what I personally use, 12.5% increments versus my buy price. There are fixed amounts. You can move it by a fixed amount of point or ticks, or you can just have a market order where you say, I just want a market order executed as it goes up. Or you can have a limit order, which is a market limit. So in other words, you set the price, it's a market, but it's a limit at that price. You have a risk, by the way, of that not filling. So if you use a trailing stop that is a market limit, you want to make sure you have what I call a fail-safe stop in the market as well, in case it continues to go through your price. All right, so you're going to want 2 stops in if you use a market limit. My recommendation is when you use a trailing stop, you use a market order. Okay, a market order is going to be best for you. How to set up and use trailing stops on the Plus500 app. Now, we've sort of talked about this already, but you open an order ticket by clicking buy or sell on the trade screen. You guys can look at your Plus500 app now or download it. And this, by the way, this is being recorded, so it will be up in Plus500. The second thing you do is select trailing stop under stop loss, which you could see here. Number 2, you see the arrow, you blew out the trailing stop. So you slide the button over just by tapping it. Third thing you do is you set the trailing stop by dollar amount. Now notice below that, price difference to loss. I'll annotate that so you can see it right here. Price difference to loss, that's percentage right there, okay? That's percentage right here. Yeah, I don't know why this is here, guys. I'm just not able to operate this as well as I should be, this platform. So this is where you see the percentage if you're somebody that operates in percentages. And again, you could either do this by plus or minus, or you can type it in directly, but this is how you do it. Fourth, you choose your order type, whether it's going to be a limit or a market. And then fifth, you confirm and place the order. Once you've placed the order, that trailing stop will follow your trade around. Okay, so if your trade goes up, the trailing stop will adjust by the amount that you asked it to. Okay, if it just happens to turn around and stop you out, it'll just stop you out. But if it's a long and it goes in your direction, the stop will follow you. So one of the things I recommend people do in these kind of situations when they're using a trailing stop is to put that stop in as protection, okay? And then watch the trade to see what the kind of performance looks like based on your strategy. What this kind of a system can do is keep you in trades longer, trades you otherwise would have panicked out of. Again, the example, you're up $25, you're up $50, you're up $100. And then all the trader can think about is, what if it turns around and I lose this money? Now, the reality is you don't actually have that money yet. It's a paper game. All right, and this is the hardest thing to teach traders. But by using this trailing stop function on Plus500, you can teach it to yourself. Okay, you can see, wow, this turned around, stopped me out on the trailing stop, but then never reached my original stop level and turned around and went back up. Okay, there are examples of this that happens all the time. And you don't necessarily want to learn that by taking the loss first. Let's talk about best practices for using trailing stops. Use a wider trailing stop for volatile markets. This is something that I teach and talk about every time anyone asks me to teach. If you're just grabbing a stop out of the air, okay, you're just saying, well, I'm in at this price. I don't want to lose more than $50, so I'll put my stop at a $50 level. You're not acting like a professional, okay? You're not teaching yourself the right way to do things. What you should do, crude oil is more volatile than treasuries, okay? Bitcoin is more volatile than copper. Well, that's pretty close lately, but let's just use that example. If you're trading a more volatile commodity, you want to have a smaller position size and wider stops. And the same is true, by the way, for trailing stops. Okay, if you know there's a commodity that has a small average true range and another one that has a large average true range, you want to adjust your stops accordingly. You adjust the stop dynamically based on market conditions, which is the second point that you see on your screen here. Okay. If we've been in a consolidation pattern, you could probably tighten your stops up, because when that consolidation pattern explodes, you probably want to get stopped out, especially if it explodes in the opposite direction of your trade. Set reasonable stop distances to avoid premature exits. Again, that will be based on the volatility, the recent volatility, or price ranges that whatever futures contract you're in has been trading within. So if you just start, for example, are trading something, let's call it crude oil, and you say, I'm just going to put my stop below yesterday's low on a long position, but then you look at the recent price action and the previous 3 days have been much wider than the previous day, you want to be further out than just that previous day's low. You want to set reasonable stop distances to avoid premature exits. Test different settings using micro futures before you trade them on more, or using one micro future before you trade 10 micro futures, right? You want to test these things out, get very comfortable with the trailing stop feature, and then start taking more advantage of it. You can combine trailing stops with technical indicators. Now, this is something that I do. I told you guys that I use 12.5%, right? That's because those are Gann lines. Okay, Gann lines go every 12.5%. And I know through research which Gann line is more important than the other Gann line. So I use those Gann lines for my trailing stops. Now, like I said, I learned trading by using trailing stops. I still use them today. Okay, now I will exit portions of my positions with a trailing stop, not the entire thing. I really spread my trailing stops around based on a position. If I have 50 micros of something, I might exit 20 of them with a trailing stop at 12.5%, another 25 with a trailing stop at 50%, and then the balance with a trailing stop 75% from my original entry. So that's the way that I do it, is I shift the sizes around. But for you guys, you should practice on micros, one contract, use a trailing stop, and try and combine it with the dynamic stops based on the volatility of the individual markets. The best, to me, the best technical indicators, because I know somebody's going to ask that question, is dynamic moving averages combined with ATRs or VWAPs. That's sort of what I would do if I were just starting out with trailing stops. Common mistakes traders make. Scream out if you have made any of these particular mistakes. Okay? Setting the trailing stop too tight, okay, leading to early exits. If you enter a crude oil trade at 65.60 on a long side and you set the trailing stop 5 cents below, you're going to get stopped out. Okay? It's going to happen. Bridget, tell me what you want me to repeat and I'll repeat it. Okay, I'm sorry. I'm trying to make sure I get through this. So you set the trailing stop too tight, and then you allow no particular movement, no back and forth in the market. Generally, when you're in a trade and you're in especially a long in commodities, okay, markets generally don't go straight up or straight down. Generally, an up move goes like this, okay, and a down move does the same thing. So you want to leave room for those sort of interprice machinations, indicators. Dynamic moving averages, Bridget. I use the 8 exponential moving average and the 21 exponential moving average. And sometimes I keep my trailing stops below the 21 if I've entered. I'll actually be able to show you that on a chart that I'm going to show you in a minute. Also, VWAP and ATR are good ones to use. Okay. Number 2 on the trader's mistakes, ignoring market volatility when setting stops. I feel like that's sort of the opposite of what I just said. If you ignore what I just said, that's a typical mistake. Using trailing stops on highly illiquid instruments. If you're trading something that is highly illiquid, trailing stops are just going to stop you out. You're better off just kind of using an entry, using a stop loss on the entire position, and having a target that you could exit at. Forgetting to adjust stops as trade conditions change. In other words, let's say that price has been consolidating in the ES lately. You can tighten your stops up along the way. Okay, your trailing stops. When you get that blowout that stops you out, you'll be glad you have the stop in place, and then you widen them out again. Relying solely on trailing stops without other risk management techniques. I feel like this is a direct mention of position size, thinking in percentages, making sure you're not over leveraged versus your particular financial situations. One of the problems with risk, which is something I talk about a lot, is you can't really advise people in a group setting on what their risk should be. One of the questions I get more than anything else is, how much risk per trade should I be taking? And if you put that into almost any search engine, you'll get most trading gurus. I hate that word. I hate the word guru. Most trading educators say 2%. 2% of what? 2% of your trading account, 2% of your total net worth, 2% of the capital you've allocated to this particular strategy, 2% of the capital you've allocated to this particular asset class. There's all kinds of things that you have to consider when you're trying to advise somebody on risk. So you have to incorporate a bunch of different risk management techniques. And that's why we're doing this trailing stop presentation, because trailing stops are one of the things you can use while you're learning to incorporate all the other things that protects your capital. It's more important than anything to protect your capital. It's more important than making gains. All right, example one, catching big moves in trends. You're trading the E-mini S&P 500. ES is in a strong uptrend. Now, without a trailing stop, you set a fixed stop loss and exit too early. In other words, you have a fixed stop loss right after you enter the trade, and it dips, stops you out, and then rallies or continues to rally in the strong uptrend it's in. Okay? That's part of the problem that happens when you're not using trailing stops. With a trailing stop, here's your entry, here's your stop. Here's your trailing stop, and it just kind of goes like this and follows along in the uptrend. So you can set a trailing stop wider away initially, knowing that as it moves in your direction, the trailing stop's going to move with you. Here's an example. Okay, now this is a very, I'm going to need this pen thing again. I wish I could figure out how to erase what I put on here originally, because it's going to pop back up again. Oh, there's the eraser. Okay, good. All right, so I'm going to erase some stuff here. There, look at that. I figured it out, guys. I'm not that old. Okay. This particular trade here, by the way, this is a real S&P chart, and this was a real trade that was triggered, okay? Here, I got a close above this double bottom pattern, okay? And there's a target in the move up this way. If I put too tight of a stop, because I entered here, okay, right in this line here, I entered. Let's get rid of some of these other ones now. If I entered here and I put a really tight stop, okay, I might have gotten stopped out anywhere in here, okay, from these two lows. But rather, I put a trailing stop down below here that then followed up the whole way, okay, and then was able to follow up throughout the rest of the move. This is one of those examples where I might have gotten stopped out immediately after the entry if I was concerned. There's something else to look at this chart. When you see, if you have a trailing stop, which by the way, this is a visual example of one of the things I use for trailing stops, but again, we don't have time to go into this right now. These are all Gann levels, okay? So as I enter a trade, I first have my initial stop below one Gann level here, then below another one here, then below another one here, then moving on here and here and here, and I'm able to stay in through a big chunk of this move. Okay, so this is a really good example of one of the ways that trailing stops, if you're not using it, you can get stopped out. This is also a good visual example of having a lot of profit in a trade. Here's where it is. You have a lot of profit in this trade, right in this area here, and then you get this dip, okay? And people panic out and they miss that move, okay? That's why a preset trailing stop can help you avoid getting stopped out here, okay? And thinking, oh, I had all this money and now I don't have as much. Well, I got really sloppy, didn't it? So anyway, it's a real good visual example of that, okay? Example 2, managing volatility in choppy markets. You're trading crude oil futures, which has sharp price swings without a trailing stop. Okay. You watch a profit turn into a loss in sharply moving markets, affecting your psychology in a bad way. When you have a profit that turns into a loss, okay, that is one of the most psychologically damaging things that could happen to a young trader. When you've done it as long as me, you're like, well, it was a paper gain anyway. It wasn't a real gain. You have to kind of try to remember that it's not a gain until the cash is actually in your account. Okay. Now I know that futures settle to cash every single day, but you know, if you're holding something more than one day, that's right back to potential risk the next day. As a matter of fact, you get the cash the very day that the futures close, and then it's taken right out of your account again the next day if it turns against you. So without a trailing stop, you watch profits turn into a loss in a sharply moving market, affecting your psychology in a bad way. Now, with a trailing stop, you adjust dynamically to the price action, avoiding fast, significant reversals. Now, I wrote that wrong. You don't avoid them, okay? You avoid the damage that comes with them, where you had a gain and it turns into the original allocated loss. Because all you can think of when that happens is that you were stupid and you weren't. Markets move. Okay, markets move all the time, oftentimes for reasons that you can't foresee, you can't predict, and you can't see how much longer they're going to go in the opposite direction. So let's look at a chart that relates to that. This again is a real chart that I'm going to annotate here, okay? This particular trend line right here, I need my pen. This particular trend line here indicates a buy signal for me in a much more complex strategy that, again, we don't have time to explain. And the buy signal is when I get a close, a positive candle, so a green candle above the trend line, which happened right here. Okay. Now, just remember that. I'm going to erase the arrow so that we don't start to get confused. Okay. Now, the next day, so I buy on this close. Here, I have profits. Here, I have more profits. Then it starts to turn around. Then it goes down here. Okay, now, with a trailing stop, the second I'm in here, I probably get stopped out somewhere around here. I didn't actually get in this trade for reasons, again, I can explain. But I got in here and I got stopped out here for a very, very small loss. Okay, and then it just continues lower. Now, a lot of people would say, okay, I had profits here. I had profits here. I should have just gotten out. Well, if you just get out, you end up avoiding or you end up losing on those longer runs, like I just showed you in the last one. Here, if you get out right away. So you end up with very similar situations where if you have a trailing stop, it protects you. This might have even been a small gain when the trailing stop got triggered. Okay, again, I'm not really sure at this particular time. It's a little bit older of a real world scenario. So this is essentially why you want to use trailing stops as you're developing as a trader. Okay. Example number 3. Risk management for small accounts. Now, this is a very important thing. If you're starting out with your first funded account, which, by the way, you will never know if you can trade or not until you actually start trading live money. Many people make money in demo, and one of the best things about Plus 500 is it is unlimited free demo with live prices. Okay, you get the actual prices that the funded accounts see, and no one else does that. But you often can make money when it's demo, and you don't know until you have real money on the line if you're going to act the same way. Okay, so if you have a small account, you should always start off using a trailing stop. Okay. You should never just have, this is either going to be a big loss or a big gain when you have a small account. You should try and keep all your losses to a minimum and try and let winners run. Now, down the road, you might find, by the way, this, what I'm about to say is the case with my strategy, my particular strategy that I use every day. I often get into trades and they go against me right away. I have not found a way to filter that out without affecting the overall long-term performance. So I've just accepted it as I continue to slowly work on it. But when you have a small account, it is much more important to protect that capital in your small account. And trailing stops helps you do that. And it also helps you let trades play out, because you go from, okay, I'm risking $10 on this, right? Now I'm risking 8. Now I'm risking 5. Now I'm risking 1. Now I'm positive 3. Now I'm positive 6. I'm stopped out at positive 6. Let's continue to watch the trade as if I still had it on and see how it plays out. And that's the value of trailing stops for smaller accounts. The most important thing to do is to protect your capital, especially when you're first starting out. So a new trader with a small account using micro futures, for example, your key takeaway one is trailing stops help you manage risk efficiently when you have limited capital. That's the SpongeBob. One risk management rule you guys should all remember, and this really applies to everything, and trailing stops sort of personifies or epitomizes this particular line. I've been using this line in sessions with traders for 20 years. My rule, it's on my trading computer right over here. It's on a piece of actually a trading card. Trading card similar to this. Show the trading cards someplace. They look like this, okay? It's written and it's taped to my computer. Never increase risk, only reduce it. In no scenario do I increase risk. The only time I ever add to trades is when they're already profitable. Sorry about that. It's getting late here in Florida. I only add to trades when they're profitable. I never add to losers, and I never move my initial stop, and I still use trailing stops because they automatically reduce risk for me as my trade is moving in my direction. So never increase risk, only reduce it. We had a really good turnout here, and I appreciate that. We're going to do more of these. And if there's anything you guys would like to see me talk about, you can reach out to Plus 500. I'm happy to do it. Again, I want to thank Plus 500 for allowing me to talk to you guys. And I want you guys to, again, think about the disclaimer that was at the very beginning. I'm going to put that up on the screen again really quick, just so that we can talk about it one more time before I say goodbye to you guys. The disclaimer is very important. I tell people all the time to put a mirror on your trading desk, okay? Trading in futures and options carries substantial risk of loss and is not suitable for every investor. If you don't actually think about the amount of loss that you can tolerate, the fault goes to the person in the mirror, not to anybody else. So please make sure, guys, please make sure you consider risk before you do things. Okay, it's very, very important. Futures trading is not for everyone. Okay, it's not for everyone. But I think all of you watching this has the ability to succeed as a trader on some level. It's up to you to figure out that level, and we here at Plus 500 are here to help you with that. Okay, my name is Bob Iaccino. Cheers again, guys. Thank you so much for watching me. I really appreciate it, and I will see you guys next time.